As we said, financials start to begin results tomorrow. Our next guest firm cut some estimates for 2023 by about 8%. Let's bring in Tom Michaud, CEO of KBW, a Stifel company, who's here as he normally is prior to the season. Good to see you.
Good morning, Carl.
So tomorrow, is it going to be, is every eye going to go straight to the loan figure and the reserves?
I think the big story is what's happening with net interest income. So we just had peak net interest income last year. And as you know, net interest income is the vast majority of revenue for banks. We are looking for net interest income to be up 25% year over year, but down 4% linked quarter, which I think demonstrates what's happening for the downshift in revenue growth in the banking industry. And really, I think the heart of the question is, COVID happens, $5 trillion of deposits find their way into the banking system. We go from 13 to 18 trillion of deposits. Purposefully, due to Fed policy, that money's leaving. For example, JP Morgan has $600 billion on deposit at the Fed. We think that'll be $300 billion by the end of the year as deposits run out. So I think it's really the story about what's happening to this deposit narrative that it's going to, I think all the eyes are going to be on. So what is that going to do to earnings, as well as what is that going to do within the industry between the big and smaller banks?
Meaning deposit rates go up?
Well, the industry
tries to get competitive, or
so treasuries are extraordinarily competitive with deposits today. And by the way, the banking industry knew this and was planning for it. They knew that these were surge deposits from COVID. So these surge, we're still have 20% of the way to go for the excess of $1.5 trillion or so of surge deposits that we think are in the industry. So deposits are leaving. The industry was managing it. We had a critical moment in March. But we're still going to have to manage our way through this moment. And I think that's what investors want to know. How much do they have to pay up to keep deposits? Where are the deposits going? And how do investors feel about the quality of the balance sheets? I think they're going to feel pretty good, but I think those are going to be the questions.
You know, I wonder, though, Tom, I'm looking here. It's a tiny bank, the Bank of South Carolina, but it could be perhaps reflective of what's going to be the overall tone in the quarter. They say, hey, you know what? Our 2022 first quarter was behind in our profit plan for the first 3 months because of a precipitous increase in our deposit costs to meet the intense competition amongst banks, brokerage, and the U.S. Treasury. Aren't so many regional banks going to be facing that same problem? And, you know, yeah, you can get more from loaning, but we're talking about credit tightening and the fact that they may not want to make those loans.
Let me tell you what our earnings models for the 225 banks that we follow say, which is what you just said. We think revenues for the industry for spread lending is going nowhere for the next 2 years because of all this deposit pressure. So that's going to, and so we think that net interest income is going to be lower by the end of the year instead of higher because of what you just said.